Here are 9 financial habits that are keeping you broke. Number 1, thinking it's impossible to have financial success. A lot of people have a lot more control over their finances than they might realize, and a recent study shows that if you have taken a finance course, that you're likely to have a net worth that is $100,000 higher just off of one course. So I'm hopeful that through this video, I'll be able to help show you some tips and tricks that will help you be a lot better with your money. Number 2, thinking budgets are really restrictive. Budgets actually give a lot of permission to spend money. Before I was budgeting, I felt guilt over every single dollar that I spent, and I started to just wonder, I don't really need to go to this concert even though I really want to, or that I don't have to go get this coffee, or I don't have to go get ice cream or whatever, and I can instead save that money. And it gave this complex with every dollar I spent. But if you have a budget, you can end up having permission to spend money in all those different places. A common budgeting rule is the 50-30-20 rule, where you spend 50% of your income on needs, 30% on fun. That's a huge amount of money to spend on fun, by the way, and 20% to invest and plan for your future. It might be really tough, but the biggest thing is to try to get your needs below 50%. And that might mean having a roommate. It might mean that maybe you're already there. But if you give yourself that permission of having 30% for fun, 20% for investing, so long as you don't already have super high interest debt, then you're going to be a lot better off. Number 3, thinking in terms of monthly payments. Everything is affordable if you think about it in a monthly payment plan, which is it just kills me that Uber Eats has this whole thing where you can have a payment plan for a Chipotle burrito or something. It's absolutely devastating to your future, and it's such a short-term gain out of a long-term and even short-term sacrifice, because those sacrifices still happen. The following month, you have to make that payment for it, and then you just have less money next month. And if you continue that cycle, it just only makes the problem worse and worse. Don't think in terms of monthly payments, think in terms of net worth and how can I actually grow my financial future. And you'll actually see, if you stop having all those different payments happen, you actually end up with more money to spend on fun stuff. Since paying off all the debt that I actually have more money for fun than I ever did before. So I promise that will help you be a lot better financially if you think in terms of net worth, not in terms of monthly payments. Number 4, carrying high interest debt. I think a lot of people don't realize how devastating this is. We have a huge credit card debt problem in the country where people have an average credit card debt in the thousands, which if you think about the interest you're paying on that between 20 and 30%, that is robbing you of so much future buying power. I'm not saying that credit cards are totally wrong. I use credit cards, but I will never have a credit card interest accrue. As the Money Guy Show says, credit card use okay, credit card debt no way. Number 5, not making investing easy. One of the most important principles in finance is to use what we call dollar cost averaging, where you continue to buy in the market continually over time. So if you invest every single month or every single week or every other week, you never know when the high or the low of the market's going to be. But the person who is consistently buying, ABB, always be buying, is likely going to be better off than almost everybody who's trying to time the market. Almost every single study shows that 90+% of people who try to time the market are worse off than people who just make it easy and just automatically keep contributing to your 401k or investing in some brokerage account or a Roth IRA. Finding those different investment options and making it automated and making it easy dramatically helps your financial situation. Not only does it help your financial situation, but it also gives you a lot less stress. You don't have to be looking at the stock market all the time, which is another just general tip is don't look at it all the time. People get way too stressed about it and then they make emotional decisions and then they end up making the wrong decision and they sell right before the market starts to recover or something. And again, you never know when it's going to happen. So just always be buying, periodically check in on it, but don't be staring at it all the time either. You'll likely have a higher net worth and you'll have less stress. Number 6, not having an emergency fund. We've all been there where something happens and all of a sudden the transmission goes out on your car, or there's an issue with your water heater or the water tank or something, and now you have several $1,000 expense or $1,000 or several $100 expense, and not having an emergency fund is drastically going to hurt you because then you might need to take out debt to cover that. And as we talked about earlier, if you're paying 20 to 30% interest on a credit card, that is absolutely robbing your financial future from yourself. So if you have an emergency fund, that prevents you from having to do that. If you don't already have one, a good baby step is to do what Dave Ramsey says and at least get $1,000 to start and then start paying off your high interest debt and then finish funding that emergency fund by getting a 3 to 6 month emergency fund where you take whatever your expenses are throughout life and you have at least 3 months of expenses saved up in an emergency fund so that if you lose your job or something does go wrong with the water heater, that you know you'll be okay. Again, this will give you a lot of peace of mind. Number 7, not tracking your net worth. It can feel really difficult to feel a sense of progress with your money, but it's especially difficult if you don't even see the numbers of how things are going. So you'll actually end up seeing a lot of that progress, especially if you're continually buying into the market. You'll start seeing that, oh, my numbers are going up. There's years where it won't be up. For example, this year, my money is down right now. But with the money that I've been contributing, I'm like almost breaking even as of the time that I've been recording this. But essentially what's going to be happening is you'll see that sense of progress, and it'll give you that motivation to keep going. It will also help you be aware of where your money is and where you might have oversight of, hey, I didn't realize I didn't even have this 401k anymore and I need to go check on it. And find that you actually had more money than you think. There's a website for every single state called Escheatment, where if you look at that, it helps figure out the money that you might have lost track of, or money you didn't even realize was in your name anymore. And you might have hundreds, if not thousands of dollars there. So look up your local state's Escheatment site and you'll be able to see if you might have some extra money. Number 8, continually starting over again at entry-level jobs or not growing your career. It's really tough. I've seen a lot of people that just bounce around from entry-level job to entry-level job, and they don't actually see that career growth happen. If you can stick around a little bit to end up growing your career, even if it's just 3 to 5 years at a company and then you move somewhere else, you'll probably see a lot more career growth. And if you're stuck in a place where there's nowhere else to go, I was in a place like that once, then you might have to look at what certificate or license or like course can I go through that might help expand my career. So for me, I took a financial analytics course and then started applying for senior analyst positions, and then ended up finding one that gave me a notable raise, but then also gave me just the opportunity to move into other positions now. So sometimes it's an income problem and you actually have to find another job or find a way to grow your career. And you might be a lot better off financially as of that point. But you still have to make sure you follow the good money habits first, and that you're not just thinking that it's only an income problem. In fact, most people making over $100,000 a year still claim that they're living paycheck to paycheck, which is just absolutely devastating. And it shows that it's not an income problem, that it is a behavior problem. And if we can focus on the behavior, you'll be a lot better off. Bonus tip, this might be a little hard to hear, but if you can't afford to live somewhere, you might not be able to afford to live in that place. A lot of people might argue that, hey, how am I going to get my needs under 50%? I live in Los Angeles or New York. The answer to that, which is a tough pill to swallow, is maybe you can't afford to live in New York or LA right now. And maybe you will want to get back there. And I fully hope that if that's where you want to live, that you can get back to those places. But you might have to move somewhere a little bit cheaper, like Oklahoma or Alabama, where they just give houses away. Like they come in like kids' Happy Meals or something now. Like you get so much money, so much further with your money in lower cost of living places. And you might have to take that short-term sacrifice to be able to get there. Number 9, taking money out of retirement accounts or out of investments in general. The whole concept of the always be buying is because in the long run, the stock market's historically always returned a positive return. There's never been a period over 20 years where the stock market has ever been negative. So if you continue to just let your money grow, it starts to grow and then grow upon itself. It starts to snowball more and more so that it ends up being exponentially larger. And if you take a loan from your account, or if you take money out of your account, you're unplugging that growth potential, and it's robbing you of thousands and thousands, if not hundreds of thousands of dollars by doing those things. I would fully encourage you, unless you absolutely need to, try not to take money out of your accounts. Instead, make sure you've got your emergency fund, make sure you're budgeting, and you'll be a lot better off. I hope these tips were helpful for you. And if you want more finance tips, make sure to follow for more.